Hi, I'm Ross from Smith Property Accountants, and we're going to look at a property that a client sent through to me today. You're going to have to put up with my little scribble. I didn't want to share the exact information about the property, so we've done a bit of a scribble rather than sharing the exact details. So you have to excuse my great artistic skills, but this is basically one house. 3 bedroom upstairs, 3 bedroom downstairs. It's in a smaller beach area in the South Island. We're looking at buying it for 550,000. Like I said, rent upstairs, downstairs, but it might not be legal. $400 rent for each level, so $800 a week. So what we want to do is have a bit of a look through. What do the numbers look like? So first thing that I would be looking at for this property would just be checking that area and location. So what is the demand for rentals in that location? Talking to one or two property managers and just checking, can we get $400 a week for each property? Can we get $800 a week? Most likely, I would discount that slightly. I don't know whether you would long term in a smaller area always get the 52 weeks. So I've just been a little bit conservative and gone 51 weeks. The cost of this property, 550,000, but it's not legal. So to legally consent it, you might spend $50,000 extra, making sure the firewalls are done, the council's done properly. So it is then two separate legal entities that you can rent out. I always do 100% debt. So if you're putting in some cash, awesome. Great that you got some cash around, but you want a return on that money. So great to work on 100% debt and to see what that looks like. We've got some costs to buy. You're going to spend money on a valuation. You're going to probably set up a company. There's other costs that you incur, building report, and then you'll get some sort of contribution back from the bank. So basically borrowing 100%. In this case, 51 weeks at 800 is 40,800 divided by 600,000, 6.79%. Nobody corporate on this property. This is the South Island, a little bit higher insurance. I'd probably go, or it is just in one house, maybe 3.5. Interest rate at the moment, ANZ's 5.59%, which is great. Got some property management rates. It was actually on the listing. I will just find that for a second. Sorry, $4,614. Repairs and maintenance going forward. Yeah, this property was on, like, it's got a reasonable section, a reasonable house. There is going to be two houses, so maybe 4,000 a year. Looks in really good condition, but it does need painting. And yeah, obviously from my picture, you can't tell that with my great artistic skills. But yeah, what we're trying to do is just be realistic on repairs. If it's brick tile brand new, maybe just $500 a year each. If it's older, needs painting, large trees, shrubs, grass, a bit more repairs. Our client is Christchurch based, and this is relatively close, but we're still probably going to spend $500 a year on travel. Maybe join Christchurch or Canterbury Property Investors Association, maybe get some other seminars or education. So we've got 40,000 rental income, 53,000 out, losing 12,000 a year. We would then get valued in, who would value the carpets, the curtains, the dishwashers, the stove, the heat pumps, all the different parts of it. It looks in good condition, so we would get a reasonable amount over the two properties. And to start with, that's just going to give us a bigger loss, which is going to be more losses to carry forward if this is our only property, because ring fencing's in from the 1st of April 19. Based on my predictions over the next 10 years, it is not this property. It is the one in the middle. So what I'm predicting is we are predicting that it's basically going to break even. So it's not going to make a huge amount of money. It's going to lose $175 on average per year, interest only, or over 10 years, $1,749. So it is not an amazing cash flow, but at least it's not costing a whole lot. That's interest only. If you had to go P&I, minus 9,415. So the cash flow is okay. Yeah, probably be more interested in beach property. How good is it likely to go up in value over the next 10 years? Seems relatively cheap at 550 or 600,000. The first 3 years, we are looking at losing 23,000. So losing 12, losing 8, losing 3. We'd love that to be positive, but it's actually not that bad. And then over the next 10 years, we're obviously expecting that to go up a little bit and to improve. So yeah, we've got over the next 10 years, rent going from 40 up to about 60,000, all our expenses going up over time, interest rates slowly coming down and maybe settling at 4.5. It'll never go that even. It'll never be perfect 4.5% a year, but that's what the Reserve Bank is saying should be the neutral OCR. So we're losing money in the first 5 years and then gaining money the next 5 years. It's quite average for cash flow. No taxable profit at all, no tax to pay. And our problem, which is I highlighted before, that profit or loss over the first 3 years. So we're hoping conservative numbers, it goes up 332,000 capital gain in the next 10 years. No one knows what will happen. That's a big guess based on history. And it would cost us $1,749 total cash to get through that 10 years if we're on interest only. It's okay, but you're definitely interested in the beach part, and definitely the nervous part would just be checking, is the rent realistic? Can we get tenants? What is the demand? It would be interesting. This client's actually got a little bit of money. So say they put in $200,000 into this property. We would then be 40,000 in, 41 out, break even on year one. In future years, it would average about $7,000 positive cash flow on interest only. It's a 3.49% return after tax on their 200,000. So generally, property is not great on your cash return. In this case, 3.49% after tax is actually not too bad. And then you're hoping historic average 6.3% for capital gains. So you're hoping 3.5 cash return plus 6.3, you're up to almost a 10% total return, and that's after tax. So that's actually starting to look quite attractive for them. Maybe some good capital gain depending on exactly that beach location. But yeah, property that'll pay for itself if they put in a little bit of money, getting a good return on that money, and starting to build up a reasonable property. So it works basically because there's the dual incomes, that there's two properties on one. With their money in, it also gets rid of that negative 3 years. It would break even, make a little bit, make a bit more in the third year. So it would actually be, yeah, quite positive. So yeah, it depends exactly what the client is after this. If they really want to jump ahead and buy a property and then another property and another property and have 10 in the next 10 years, this property is average cash flow. So it's going to act a bit of a handbrake, but it's not terrible either. It's not disgusting cash flow. So yeah, hopefully it's given you information and something to think about. So thanks a lot for your time, and we'll leave it there. Thanks. Bye.